There's been incredible volatility over the last couple of weeks because of the situation between the US and Iran. But historically, how does military action affect the price of oil? And what does this mean for traders? Hello, I'm David Jones from Capital.com. I thought we'd do another update on the price of oil. It remains volatile. We've seen some enormous movements just in the first couple of weeks of January. And at the time of recording, the price is under some pressure, which is, I think, an opportunity. But I thought, let's take a slightly different angle this time round. We'll take a look at, go back over the last 150 years, look at the effect of military actions on the price of oil and see how important situations like US and Iran are at the moment, or is still what's going on with the economy of much bigger concern. So what we're going to do in this video, we'll catch up with what's been happening over the last 2 weeks or so. I'll come back, talk about some of the factors behind that, the big levels to watch. Then we'll jump back onto the trading platform and look to see where the opportunity may be for a trade. And I think it is at a really crucial point. As usual, if you're watching this and you haven't subscribed, if you can click on subscribe, support the channel, and we will continue to push out regular content on all these different markets through 2020. First of all, let's catch up with what's been happening over the last couple of weeks. So this is what we're going to look at in a couple of minutes in a bit more depth. What impact war and tensions like that have had on oil over the last 150 years? And really, what is the big driver? Is it more these sort of conflicts, or is it the economy? But first of all, before we get into this in a bit more detail, it's about a very quick catch up with what's been happening with oil so far this year. So this is an hourly chart. This is what we've seen happening with the oil price so far this year. So it came into 2020 around $61 a barrel. Then, of course, we had that military action between the US and Iran, spiked up to $65.50 a barrel. But since then, since January the 8th, the price has been in decline. It's dropped more than 10% to trade briefly below $58 a barrel. I'm going to talk now a bit more about the factors affecting oil apart from what we've seen so far this year. Then I'll come back. We'll look at the effect historically that wars have had. Then we'll have a look at oil in a bit more detail, because I do think this volatility is an opportunity for the next few weeks. So we'll go back and look at this in a lot more detail in a second and look at this historical perspective for military action. But clearly, the big driver this year has been the action between the US and Iran. We saw it spike higher up to $65 a barrel, slightly higher when Iran attacked those two US bases. But since then, we've seen the price drop. It's dropped by more than 10% over the last week or so. And I wonder, is this the opportunity? And I'll talk about why in a second. But first of all, let's take a look at the big levels to watch for the weeks ahead. So the highest we've seen the price this year is $65.45. And because it's such a sharp fall off, there's very little left in the way of major peaks on the way down. But I think just above $60, an intraday high from the 8th of Jan. And of course, $60 is an important psychological level anyway. Where I think the opportunity is where we look at the downside. And a really big short-term level to watch is from December. It's around about $57.60. It was important short-term support. At the moment, we are seeing oil sort of hovering around there. So let's get back into the chart, look at things from a historical perspective, the effect that wars have had. Then we'll get in and look to see where the trade might be. So let's take a look at the really long history for the oil price. We're going to go all the way back to the US Civil War. So we go back to the 1860s, and we can see here massive spike in the price of oil. This chart is adjusted to show the equivalent price in 2013 US dollars per barrel. So inflation adjusted and currency adjusted, all of that sort of stuff. So we saw clearly a really sharp move in the price of oil there on that war 150 years ago. But actually, if you look at the effect since then, wars don't have, famous last words, that long lasting an effect. If we take a look at the First World War from 1914, we did see prices rally for most of the duration of that war. But then if we jump forward to sort of 1939, the outbreak of the Second World War, if you live in Europe, maybe not if you live in the US. So we saw, again, something of a short-term spike in prices, but prices actually in decline. Then if we run forward to the late 70s, and 1980. The outbreak of the Iran-Iraq war was another thing that caused a spike in the price of oil. But then we can see the other highlights on this chart are recessions. So we can see that the economy had a much bigger effect in dragging the price of oil lower. The invasion of Kuwait by Iraq in 1990, the outbreak clearly of the first Gulf War. Again, you can see the price of oil spikes, but what had a much bigger effect was an economic slowdown into the mid 1990s. Then in the early 2000s, 9/11 happened, of course, the attack on the Twin Towers in New York, and the subsequent military action against Iraq, increasing worries about Middle East instability, and we saw the price of oil rise from there. But of course, there were plenty of other factors. I think we've looked at recessions and oil in the past. And I think what's going on from a global economic point of view, clearly has a much longer term lasting effect on the oil price. As we've already seen this year, military tensions can really spike volatility and drive that price up. But again, as we've seen so far in January, it doesn't necessarily mean the price is going to stay up there. So they provide price shocks, these sort of events, but what's happening with the wider economy clearly has a much bigger impact. Let's jump back onto the platform, take a look at the price of oil in a bit more detail and see where a trade could be. So we'll leave the history lesson to one side for now and take a look at this price chart. Look at the historical price data rather than the historical conflict data for oil. I think it's interesting what we've seen happen over the last week and a half or so. The price has really slid back. And for me, it's all about this trend line. I've got this on an hourly chart at the moment. We'll bring in some indicators in a second, but we've got this trend. We picked up on it in the last video. We've got this trend that's been going since those October lows from around about $51 a barrel for oil. The price, as I say, pushed up above 65.31. And we've come back to the trend line. Let me just change this to a daily chart. We'll pick out the big levels. So here we are on the dailies with some indicators on the bottom. We'll talk about those in a sec. But clearly we're back to the trend line now for oil. So from a classic charting point of view, if this market is going to rally from anywhere, then we're pretty much here. So for me, looking at this, we'll come to the trades in a second, but looking at this, I'd want to be a buyer. If we see a bit of strength, at the time of recording, it was still weak yesterday. So maybe we wait for at least a day, see if the market can stabilize. The closest I would want my stop, probably be those lows, these December the 6th lows, around about $57.60 a barrel. If we're looking for a bigger swing, swing traders would probably be looking at these lows from the third week of November down at $54.80. And then again, 29th of November, $55. So $54.80 to $55, I think is the really big level for oil. I think if we start to lose that, the risk is for a deeper sell-off. But for now, at the time of recording, this trend is still up. Looking at the RSI down here, we haven't quite gone oversold, but we've got to go back again to October to see the last time oil was actually oversold. But we are again back at these levels on the 10-day RSI that we saw at the last significant low back in late November. MACD is still bearish, really. We've got a sell signal off the MACD as the price turned sharply lower. So the MACD isn't really backing up the RSI. But for me, the important consideration here is this price chart, what the price has been doing over the last 3+ months. And we are back to that trend line and looking to see if the price can hook higher from here. So for me, it's all about this old support at 57.60 and the bigger support back here at 54.80, but looking for some confidence, for some strength to come back into this market and for oil to push back up above 60. Well, I suppose if we're expecting this trend to continue, a push up to those highs from the 8th of Jan, just ahead of $65.50. I'd normally place a trade in these videos, but in the last one, we put an order in to buy oil. And it's basically exactly what I've been talking about here. If we have a look at the portfolio, the order got filled. Let me just tidy this up. So we had an order in to buy 174 at 58.50. That order got filled. We bought at 58.50. We put a stop loss of 57, quite a tight stop loss. At the moment, the market is trading at 58.28. So we're slightly down. But for me, that trade still stands. That trend so far, it's early days, but has still held. It's been a really important trend in oil since October. So really now, from a short to medium term point of view, looking for this whole 54.80 to 57.5 area to hold and for oil to start to turn around. So clearly military action adds a price shock to these markets. But what's going on, we saw some of those recessions there, the effect that oil had, has a much bigger impact, not surprisingly, longer term. We'll leave this update there for now. So from me, David Jones, and Capital.com, good luck with your trading.